You will agree with me on one thing, that commercial banks act as intermediaries. They act as financial intermediaries. Their key mandate, in other words, is to receive deposits from the public, from you and I, and use this deposit they have received from the public to extend credit facilities to the same public. You will also agree with me that year in, year out, especially the listed banks, the ones which are listed in NSE, have been consistently reporting profits. In fact, at some point, we will say they have been exorbitantly reporting profits. So then, if their core business is to receive money from the public and to extend credit facilities to the public, and with the default rates that we have been seeing, because businesses have been struggling, that is a given fact. No wonder CBK has been intentional at reducing interest rates so as to expire economic growth. Yet, these same banks, where you borrow money and you don't pay back, where the default rate has been quite high, have still been consistent in reporting profits. How do they manage? How are banks able to report huge profits even though everybody else in the economy is struggling? If they're receiving money from you and you're not having money, your business is down, you're not able to make sales to give the banks to trade with, then how have banks been able to maintain the high profits that they're making? Banks also trade in treasury bonds. They actually receive money. Some of this money they lend out as loan, and a portion of the deposit that we give them is utilized to buy bonds, treasury bonds to begin with. So I took the trouble of reviewing some of these banks to see what their performance, how their activities in the bond market affects their performance, so that we can have a good understanding on how their investment or their trading in treasury bonds affects their performance or affects their P&L or affects their bottom line. Before that though, please don't forget to subscribe. Don't forget to hit the subscribe button. Don't forget to give me a thumbs up, and don't forget to leave me a comment in the comment section. By the way, have you reviewed the previous video? Have you watched the previous video? If you have, do let me know what you learned from it, and do let me know the additional information that you have learned from this video. Remember, we have already agreed that, in fact, if you're investing in NSE, some of the best counters to buy with consistent dividend payouts is the commercial banks, is the banking sector. So how does investment in treasury bonds affect their performance? Now, equity, out of an asset value, total assets of 1.7 billion, equity is holding 548B. Though in their latest results, they had mentioned that they're going to work on reducing their bond holdings so that they're able to lend out more money. But that aside, KCB, out of an asset book of 1.3 billion, KCB was holding 307 bonds. That is 23% of their assets. For Coop Bank, out of an asset book of 712, they are holding bonds of 115. That is 15% of their asset book. Now, with DTB, they have 136 in bonds. That is 23% of their asset book. I&M has 18% of their asset book is in bonds. ABSA, 28% of their asset book is in bonds. This is another company in NSE that always pays dividends. They even pay interim dividends. Stanbic has 13% of their asset book. That is 59 billion out of 450 billion. StanCharts has 25% of their assets is held in government securities. Sidian Bank, which is not listed, but another bank, also not in Tier 1, has 49% of its asset book, of its assets in the treasury bonds. Its total assets is 68 billion, and 33B is held in treasury bonds. That is a whopping 49% held in treasury bonds. So what was the contribution of these treasury bonds in their profit and loss, in their comprehensive profit, after deducting every other thing, all other expenses? What was the contribution of their treasury bond holding in their comprehensive profit. I'd like you to take a keen interest on DTB and I&M. DTB reported profits. Return on investment earned from Treasury bond was 5.98 and their comprehensive income was 5.65. That is 106% of their comprehensive income. The return on investment for I&M Bank was 4.46. Their comprehensive income after deducting everything else, including withholding tax paid, including capital losses from selling bonds, including staff salaries, loans, interest paid to depositors, everything else put together, they had 3.96. And remember, their return from Treasury bonds was 4.46, meaning that they had a 113%. The bonds contributed 113% to their comprehensive income. All right? Now, another counter that we may need to look at is Stanbic. Stanbic reported a return on investment of 3.02. That is 93%. Sorry, that is 93% of their comprehensive income. So, how are they able to make these profits, these returns, yet the T-bill, the bonds are at 14%, 16%, 13% through active trading? Remember, I told you before that if you want to get back your money from your investment in T-bills, then you'll need to go into the secondary market. Where is this secondary market? And who participates in these secondary markets? The banking sector is a buzz. The secondary market it's a buzz of activities. Your fund managers, insurance funds, your churches, your banks, foreign investors, all trade in the secondary market. They are always selling and buying bonds. And that is why, even though the default rate is huge, even though there's an increase in the default rates, even though interest rates are low, they are still able to report exorbitant return on investment. They are still able to report exorbitant comprehensive income or profits. So now we are all in agreement. I hope that we are all in agreement that active trading in bonds offers you a potential to earn more than holding individual papers for long term, especially for you as a retail investor in a low interest rate regime. But we don't have access to the secondary market. We don't have the skills to trade in the secondary market. We don't know when to buy or when to sell. That is why in the previous video, I introduced to you the concept of investing in Treasury bonds, actively trading in Treasury bonds through a fund manager. Not investing per se, but actively trading, buying and selling. Not just investing in the sense that you go and buy your bonds and then you earn your 10% coupons for the next 15 years, or you earn your 14% or your 12% net coupon for the next 22 years. You can actively trade. In fact, the papers that you're holding at 18%, you can sell them and buy lower coupon papers by reinvesting the premium that you have gained on the high coupon paper to get you more income. But that is not the purpose of this video. Now, in today's episode, I wanted us to understand how a bond fund will be making money, and by first demonstrating to you that yes, it has been done by commercial banks. Go to the dailies, go to their websites, pull out any of their financial status, look at their balance sheet, their total assets in their balance sheet. Check if they hold any government bonds. In fact, they have a line for trading. They have a line for bonds held to maturity and bonds available for sale. Okay, so yes, it is true that active trading in bonds can earn you money. And if you don't have the skills to do it, you don't have the resources to do it. Resources in the sense of large sums of money. You have maybe just 50K, 100,000 shillings, 1 million. 5 million, 20 million, you can do it through the bond fund. And like I told you in the previous video, the advantage of going through of taking up the bonds using a bond fund is that you don't have to tie up your money at low coupon rates, at low returns for a long duration of time. Do the bond funds. When the rates becomes more favorable, then you can swipe a portion of that, or you'll have made more money to now put in the individual bonds, as opposed to locking in for 10% at 10%. But we have different objectives. If the 10% meets the objectives, by all means, take it up. Now, I did mention a bond fund called Almasi Fund, and from the comments, I'm realizing that I didn't cover it exhaustively. So this video, I would like us to exhaustively cover this Almasi Fund. At the same time, Almasi Bond Fund, which is a fixed income fund. At the same time, if you know of another bond fund that you'd like us to review or that you'd like us to mention, please leave me a comment in the comment section, or you know of another fund manager that is offering a fixed income fund, please leave me a comment in the comment section. Just mention the fund name or the fund manager's name, and I'll make a point to review that fund as well. Now, the Almasi Fund is a product of Arvocap. Arvocap is licensed by CMA. Is it regulated? Yes, it is regulated. What is the minimum amount? You need 100,000 shillings to enter, and to top up, you need 100,000 shillings. Now, this is a question that has been coming on top ups. How frequently do I need to top up? There is no frequency for top up. You can top up every day. You can top up after 10 years. You can top up after 1 year. The top up is all up to you. But anytime you want to top up, that top up should be at least 100,000 shillings. Underlying assets is treasury bonds and top niche corporate bonds, but their portfolio presently is on treasury bonds, the bonds that are being issued to us by CBK, treasury bonds. What is the strategy? Active trading. They hold for coupons, they hold for capital gains. So that also makes their sources of return. They earn returns through coupons that are paid out to them semi-annually. They earn returns through selling the bonds at profits to make capital gains. They can also realize returns through revaluation. I'll talk about revaluation later. Their custodian is NCBA Bank, and the trustees is also NCBA Bank. What are the charges like? What does it take for you? What does it take for you to invest in this fund? What is the cost of you investing in this fund? Now, the moment you give them money, they have an initial fee of 0.5%. You give them 1 million, they hit instantly 0.5%. They also have management fees of 1%, and this is per annum prorated. The initial fee is one-off. You give them 1 million, to stay with them for 5 years, they'll only charge you 0.5%, being the initial fee for the entire 5 years. But the management fee will be charged every year. You'll be charged 1% on that, on your asset under management, okay? So assuming you're withdrawing all your earnings, so that you retain 1 million every year, then the management fee will be charged on the asset under management. They also have a performance fee of 20%. How is the performance fee charged? It is charged above the hurdle rate. And what is the hurdle rate? The hurdle rate is the yield to maturity for the 5-year T-bonds in Kenya, okay? Plus 2 BPS. That is like plus 2%. So if the yield to maturity for the 5-year bond is 10%, then the hurdle rate is 12%. So anything above the 12% will accrue a 20% charge. So now, for clarity, that 20% is not charged on your asset under management. It is not charged on the money you have given them. It is not charged on the profits they have made. It is charged on the profits they have made above the hurdle rate, okay? So that means that it is a moving goalpost. And it is a moving goalpost because the yield to maturity is not fixed. It keeps changing, okay? Next, I would like us to review their past performance. However, a disclaimer: their past performance is not an indicator of their future performance. They could actually make a loss next month or the next 3 months. They could actually make more profits than they did in the previous month. So past performance is not an indicator for future performance. Though, at a personal level, if a fund manager has been returning negatives, has a history of reporting losses, frequent losses, I will not have the courage to give that fund manager my money. So yes, it is true that past performance is not an indicator of future performance, but it is one of the things that I look at as a personal level while choosing a fund manager. So how did they perform in the previous period? Now, year to date, from January to now, they have made a gross return of 12.62. That gives us a net of tax return of 9% year to now. So if you are to annualize it, it will give you something about 17%. Last 12 months, they gave a return on investment of 22.2%. Net of that is 15% net of taxes. Inception to July, from when the fund was conceived up to July, or from when the fund was licensed, when started operation up to last month, up to July, not last month, up to July, they had a gross return on investment of 28.96%, and they had a net return on investment after removing the performance charge, after removing the 15% tax, is 20%. Their worst performance from inception was 1.9%. If you annualize that, is 12.8%. And the highest, the best performance was at 2.72% in October last year. If you annualize that, it is 32.64% gross, and the net after tax and after performance fee is 22%, which, like you have seen, is way better than the 10% now. But there is no rose without a thorn. Where is the but? Where is the catch? What are the disadvantages of this fund? Let me begin with the advantages. Number one, it offers improved tax efficiency. Why? Because the performance fee is charged on your account at the end of the year on 31st December 2020, on the 31st December, at year end, the calendar year end, or when you withdraw. So it means that if you join the fund in January and you don't withdraw until December, the performance fee will not be charged on your account. It will not be levied on your account. And when the performance fee is not levied on your account, it means that you're not paying taxes. Whatever tax you'll have been remitting to the government, to KRA, is being reinvested. And that then means that you have the potential to earn even more, as opposed to the fund where performance fee is levied every month, and so tax is deducted every month, okay? Now, this fund also offers you professional management. I told you, even myself as an individual, Berlin, I don't have access to the secondary market except through a broker. But these guys are in the market every single day. Every single day they're in the market, Monday to Friday, they're in the market. They're actively trading, looking for cheap bonds to buy and seeking to sell their bonds at a premium so that they can make the capital gains. Now, I forgot to mention when I was giving you the facts about the fund, their asset under management is 550 million. So as opposed to me, who has just maybe 1 million or 5 million to invest in the secondary market, I cannot diversify my money, my 5 million or my 10 million, as much as these guys can diversify the 550 million that they have. That gives us a higher bargaining power, okay? So by the fact that they have a higher amount to manage, as opposed to my individual investment, I don't have 500 million to invest, as opposed to my individual investment, it means that they have a higher bargaining power. They can do competitive bids, which I probably could not, because of my limitation of finances. I am not able to get the 2 million to qualify for the competitive bids. Now, these guys, they compound, they offer compounding, yeah? The fund offers compounding. How? Because money you have already received is reinvested. Unless you withdraw it, it's reinvested. Unlike the individual bonds, where you are paid out your money and you have to go to the trouble of choosing where to reinvest it, this is auto-compounded. So, of course, it cannot be having advantages without having disadvantages. So, what are the disadvantages of taking up this Almasi fixed income fund? Number one, it has mismanagement risk. Mismanagement risk in the sense that the fund managers decide to sell the papers that they have at losses, or not to seek the best bargains on your behalf, yeah? So there's that element of mismanagement, which I also possess as an individual, though. It has a higher entry point. When you want to buy treasury bonds, you need just 50,000 shillings. The fund's minimum capital or minimum deposit or minimum investment amount is 100,000 shillings. So it limits people with 50K, because the starting point is slightly higher, 100,000 shillings. That is a disadvantage. Another disadvantage is higher top-ups. With treasury bonds, you need top-ups of 50K and the fund has top-ups of 100,000 shillings. So that's a disadvantage also. Another disadvantage is the fund fees. Why? With the bonds, you don't have any fees except for the RTGS, transactional charges by your bank, but the bonds has no fund fees or no investment fees unless you go through a broker to buy the bond for you in the secondary market, or you use a custodian to buy the bonds on your behalf from CBK. Otherwise, individual bonds has no fees, but this fund is charging fees. We saw the initial fee of 0.5%, we saw the management fee of 1%, and we also saw the performance fee of 20% above the hurdle rates. Now, the fund manager also has autonomy of decisions. Autonomy of decisions in the sense that you don't get to decide where the fund, which bond is taken up. When they decide to take this 10% bond, you don't make that decision. They make it on your behalf. So you lose your autonomy of decision in choosing the bonds to take. There are some people who are crazy about IFBs. Even when the Treasury bond is available with a 16% coupon rate, they'll rather wait for that IFB that will be charging them, that will be paying them 13% interest rate. So when you invest in this bond, you take away your autonomy, you surrender your autonomy of decision to the fund manager to make the decisions on your behalf, just like we do with the money market funds. We give the fund manager our money to manage it on our behalf, and then we pay them some management fees. So the same with this bond, with this funder, the fund manager, Almasi now, Arvocap, will be making the decisions on our behalf. So those are some of the disadvantages of the Arvocap Almasi Bond Fund, fixed income fund, which is a bond fund, like we have said, is primarily invested in Treasury bonds, and they trade actively. Now, with regards to the fund, to the fees, to the fund fees, the fees that the bond charges, I think that is sufficiently mitigated by the higher returns, that the bond offers over and above the individual bonds. Another thing that is worth mentioning is that whatever performance reports they have published or they have reported is already net of the initial fee and net of the management fee, but it's gross of performance fee. So now I hope this video now clarifies the questions that you guys had from my previous video about this fund. I hope that you'll be able to now find it easier to do your research on the fund, and I hope that now it puts to rest your questions that you had on the fund or the clarity that you needed from the previous video. I felt the need to do this video because I got the impression that I might have left some gaps in the previous video. I actually thought that we already have a good understanding of how bond funds operate. That said, if you still have other questions, please don't hesitate to leave me a comment in the comment section, either in this video or in the previous video, and I'll take a moment to address your questions, because this is your home of financial freedom, where we make wise investment informed decisions.